for more on what the debt crisis means to U.S. investors. We're joined now by Vern Hayden, president of Hayden Financial Group. He comes to us from Stamford, Connecticut. And still with us here in studio, Mark Dow of Pharo Management. Thanks to both of you for joining us. Vern, I want to start with you. Mark was talking earlier about this being perhaps one cockroach out there. Mark Moby is talking about this potentially resulting in a wave of other debt defaults out there. Your perspective?
Well, I think that this is another black swan event, which are no longer black swans, because I think we need to expect the unexpected to happen. We just don't always know where it's going to happen. People need to look at where greed is going at the greatest pace and over-leveraging at the greatest pace, and they'll see where the next problems are going to unravel. And I think this one is not going to cause a total reverse in good investments. I think if people have a real solid, well-diversified portfolio,
right,
it's going to be a blip. And the important thing is to have a good, diversified portfolio where there's some defense as well as offense.
Mark, could you have seen this coming, though, defensive portfolio or not?
Definitely. Anybody who's been to Dubai in the past five years saw the scope of their ambitions,
yeah,
and thought that it's a pretty dicey bet.
Well, here's a question then, and I'll pose this to Vern. Why was the market rallying as it was when this was out there?
Well, I think it's a psychological reaction. I don't think it was a fundamental one. Psychologically, when things sound good and are going great and they look fancy and hot and going like crazy, that's a good positive, and people want to invest in that. And it's an emotional reaction, just like it's an emotional reaction when that reverses and it goes against them. I think people should still go skiing at Snowmass, buy clothes at Barney's, and you know, they make minor adjustments, but not major adjustments if they have a real well-diversified portfolio.
Mark, go ahead.
Yeah, no, I'd say a couple things that I think are important. First of all, the cockroaches really are with respect to Dubai, not to the emerging markets. I think Mark Mobius is not right. The emerging market sovereigns have been the only group that have been deleveraging in recent years.
Right.
It's actually the developed economies that have been leveraging up. That's the first thing. The second thing, I think, is that as the Dubai story, we saw it coming, but the markets work, we like to call it belated overreaction. We ignore something day after day after day, and then one day we wake up and it's the only thing we can focus on.
So, Mark, you're saying that investors who have been buying, gobbling up emerging markets are going to continue to do so?
I don't know. It's hard to say how investors will react, but
yeah,
from a fundamental perspective, right, the balance sheets of the sovereigns in most emerging markets are not at risk. And that's a big difference from previous economic cycles where they levered up along with the rest of the world, and when the music stopped, they got hit the hardest. So if you look at China, Brazil, Mexico, Russia, their balance sheets are in much different shape than they've been at the end of previous cycles. And you can't say the same for the likes of Greece and Italy and some of the other countries, which is actually where, if there were to be another cockroach in another country, that's where you would want to look.
Vern, you've been talking about defense. This is a day when there's interest, obviously, in the dollar. Tell us how you are defensively suggesting investors put together portfolios right now.
Well, my primary method of investing is using some mutual funds and really finding great managers. And it's no secret that great managers in a defensive way are some bond managers, a couple by the name of Bob Rodriguez, who's now on starting leave next year. Tom Atterbury there carrying on the work really well also. And then, of course, Bill Gross, using Harbor Bond, for instance. And these are really great defensive positions. Both of these funds were up 4 or 5% last year, yielding 3 or 4. And I think that'll continue to happen. And so that could be part of the defense. Another one would be like the Hussman Fund, who can go short. He shorts certain indexes and that sort of thing. Tends to do pretty good in a down market. But I think people need to look at those kind of things to have a really good defense. I don't think people ought to pull away from their offense either totally.
Right.
I think it's great to have an investment in the emerging market infrastructure, ETF, for instance.
Hey, Vern, I'm just going to give Mark a chance to react to your comments before we go here.
No, I mean, the merits of diversification are clear. There are always points in time at which all correlations go to 1. Diversification doesn't help you out a whole lot. But I think the lesson here is investors need to stop looking in the rearview mirror, and because they see one problem in an emerging market, assume that there are going to be problems in others. Emerging markets have been very, very different in the recent cycle. The paradigm has changed. The world at the margin is being driven by emerging markets and not by the developing markets, and that's going to continue to be the case.
Nobody said investing was easy and you had to find the winners and losers. Our thanks to Vern Hayden and Mark Dow here in studio for joining us on a very busy Friday.